We're going to talk about a simple idea today. Brown-Forman, BF.B on New York. As we've heard, people are entertaining at home, of course. They're not going out. And actually, spirits and wine have actually been very strong. And Brown-Forman has actually been pretty good too. They have more concerns still about tariffs and trade than they do about COVID-19. Okay, so with all the trade wars going on, there was some retaliatory tariffs, mostly in Europe, that did affect the company. So overall sales are actually pretty low growth right now, only 3%, but that was more an effect of the nature of the business and the tariffs. Like, it's not a high growth business to begin with, but it's very consistent. And as I said, even through this COVID-19, the bigger concern is the tariffs, not the COVID-19. This is just a solid company. Here you see the brands up on the screen there. That's just their one brand of Jack Daniels, probably their most famous. But they have other whiskeys that are well known, like Collingwood, Woodford, Reserve, and Finlandia is a vodka. Some higher end wines, just a couple of brands there, some tequilas. It really is an interesting website. Go to their website and take a look for more details on that. But they kind of focus on the higher end type of brands. I want to jump, of course, into our financial model. And there's the profile of return on invested capital. Again, it's the top bar chart there. If I can get my cursor to point at, there we go. And back in the early 2000s, returns were around 11%. Really improved the business up to about 2008, 2009. Actually, this is interesting. 2008, 2009, another kind of financial crisis, and really no change in the financials of Brown-Forman. And it's the same thing this time around. Now, there has been a little bit of a decrease, a slow bleed of slightly lower return on invested capital, which is not the best sign in the world. But, I mean, it's still 18. It's very consistent, very predictable. And something else that has kind of helped shares is they've had a pretty decent share buyback program. So shares in the last 7 years went from 532 million to now 478 million. So that does help, and I don't think this is, a bad idea for this company. They've got a good balance sheet, barely any debt, and a good working capital position. So there's no reason they can't buy back shares. This is not like some other companies that probably shouldn't have bought back shares and should have saved for a rainy day. There's no issue here. There is a small dividend as well. It's only yielding 1% right now. I'd like to see them raise that, frankly. But let's look at the dividend chart, and you can see it is quite nice. The one on the top is just the every quarter dividend. So you see they raise it every Q4, Q1 probably. I'm not sure exactly when they're raising it, but you see every fourth quarter, boom, they raise it. And then the bottom chart is the cash flow from operations versus the dividend on an annual basis, like a rolling 4 quarters. So you can see that they can easily pay the dividends, about a 45% payout ratio on the way we calculate it. That's all very good. It's just a nice picture. It looks like a textbook. Awesome. Love it. I think they could raise it a little bit, frankly. But they're repurchasing shares, so you're going to get your return of capital in one form or another. And you get consistency. In terms of trading, I think it's hard to see our chart here, but let's focus one on this bottom right. That's kind of interesting. It's where do I want to go here? It's down 13% from its 52-week high. Okay, so that's, lots of companies were down just before and have rebounded. This one definitely has rebounded off the bottom as well. Looks like it had about the March 23rd bottom in sync with the market. It is up 41% since that time, but I wouldn't focus on that. I'd focus on the value. As you can see from our valuation, still looks pretty good. That's a $77 valuation versus a $63 actual trading price, and it's still 50. It's 13% down from its 52-week high. So this is, like I said, just quick summary. It's a simple name, very consistent. You're not getting high growth. You're getting 6% growth, or three. The reason I said 6, they are getting 6% in the U.S., which is their biggest market. It's about 50% of their revenue. They're having some issues with trade tariffs, so their growth rate was a little bit low, but it's not gonna jump up to 10 anyways. It's a 8% kind of growth story, but very consistent. Repurchasing shares. It's kind of just consistency, and that's all I can say, man. I can't put it any simpler than that. High quality, simple name, keeps on making money each and every year.